interest rates are going up because of high inflation. And there's a lot of things the government has done and is doing to make inflation worse. So stop doing that. Stop the money printing. Stop the never-ending deficits. Stop the tax hikes, right?
I'm here with my friend and colleague, Franco Terrazzano, of course, the federal director of the Canadian Taxpayers Federation. I'm Jay Goldberg, the Ontario and Interim Atlantic director. And today we're going to be talking about interest rates, inflation, all of that good stuff. Franco, the Bank of Canada just raised interest rates again. I'm sure many of our listeners here are homeowners like I am, and obviously some older ones too are wanting to see their kids be able to buy homes. How are these interest rates going to affect homeowners and potential home buyers?
Well, mortgage rates tend to go up and move in tandem with the Bank of Canada interest rate hikes. Now, the Bank of Canada started raising its interest rates early in 2022. And, just before coming on the show this morning, I checked out the website Better Dwelling to look at the average monthly mortgage payments and how they've changed over the last couple of years. Well, they've increased by about 5.6% between the end of 2021 and the end of 2022. Now, that's an extra about $924 in a year, which is a lot of money. But folks, I think the biggest issue that we're going to be seeing with these higher interest rates from the Bank of Canada is actually where things are going. So how mortgage payments will increase over the next couple years. And the reason I say that is because the Bank of Canada says that the bulk of homeowners who are borrowing money will have to renew their mortgages by 2026, and they could see up to a 40% increase in their monthly mortgage payments. Now, let me break down what that would mean. So the average monthly mortgage payment in Canada right now is about $1,450. Well, a 40% increase in monthly mortgage payments would jump that up to just over $2,000. Okay, that's an extra $580 a month or an extra $7,000 a year in mortgage payments.
That's insane. Where a family is going to come up with all of those thousands of dollars. And you just mentioned, and I'm one of those, our mortgage will come up in January of 2026. And I guess I better tell my wife we might be looking at a 40% hike there. Not great news. Not great news to hand out. So 40% increase in mortgage payments, that's something that we're expecting now down the road. And that could cost people thousands of dollars every year, right?
Yeah, exactly. I mean, this is not good news. By 2026, you could be looking at up to a 40% increase. With the average mortgage payment in Canada, that's an extra $580 a month or an extra $7,000 a year. But look, I don't want to freak people out here because remember, that's the upper limit that the Bank of Canada is suggesting. So not everyone is going to be seeing that type of increase. Right. So I just want to provide a word of caution. And also, let's not forget, folks, that that's what the Bank of Canada is saying. Well, if you've been following this podcast or just the news over the last couple of years, well, the Bank of Canada has gotten a lot of things wrong, to put it mildly. But at the Bank of Canada, they're saying it could be a range between a 20% increase all the way up to a 40% increase for renewals. And even a 20% increase would mean a ton of pain for a ton of homeowners. Let me just put that into perspective. A 20% increase in monthly mortgage payments, if you take the average, would be an extra $290 a month or an extra $3,500 a year. So even at the low end, you're still looking at a huge cost to homeowners because of these interest rate hikes. And remember, bottom line, folks, is that when the Bank of Canada increases its interest rates, when you see that in the news, well, then you can expect different interest rates in the economy to go up, including your monthly mortgage payments.
So, of course, you said if things don't change, the current trajectory we're on, but if, there are ways for us to make changes. There are certainly ways for policymakers to make changes so that we don't get to this doomsday scenario in the next few years. But I guess it's first important to figure out why are interest rates going up before we can talk about, what we can do to fix the situation.
Yeah, that's a really good question. So look, people are paying higher rates because the government increased inflation. Now, to be fair, there's a lot of different things that influence prices. Obviously, international incidences, what's going on around the world plays a factor. But look, let's not take the federal government off the hook here, because the federal government should control what it can control, and what it can control led to higher prices. We're talking about never-ending deficits. We're talking about tax increases. We're talking about the Bank of Canada itself printing a ton of money out of thin air to help finance these types of deficits. So if we want the government to ease the pain of these higher interest rates, well, then the government has to stop doing what it did to lead to the inflation, which led to the resulting interest rate hikes.
Okay, I want to break this down just a little bit more for listeners in terms of how government has helped to create this inflation. So you mentioned a number of factors. Let's talk first about deficit spending and how that's helped to trigger inflation.
Well, even Finance Minister Chrystia Freeland herself acknowledged that more borrowing means higher inflation. I want to read you a quote from her, which she said last fall, quote, "We cannot compensate every single Canadian for all the cost of inflation. To do so would only make inflation worse and would force the Bank of Canada to raise interest rates even higher." Okay, but by the time that Freeland made this acknowledgement, the government had already lost control of the fiscal reins. You know, even before the pandemic, before any cross-country recession, back in 2018, the Trudeau government was spending all-time highs, even after accounting for inflation and population growth. So we were spending more in 2018 than the government was during any single year when the feds were fighting the Nazis during the Second World War. Then the pandemic happens. Well, when the pandemic happened, the government announced about $570 billion of new spending. Of that new spending, more than $200 billion had nothing to do with the pandemic. Nothing to do with the pandemic. And that is according to the parliamentary budget officer. And remember, when Trudeau was first running to be the prime minister, he said he'd run a couple teeny weensy little deficits and finally balance the books in 2019. He missed that mark by $20 billion. Then Freeland said that she would balance the budget by 2027. Well, the most recent budget shows that there's just going to be deficits ongoing. And now the parliamentary budget officer pegs the next balanced budget in 2041, almost 2 decades from now.
Yeah, so that's 18 years from now. Okay, so my 2-year-old daughter is going to be 20 and in university by the time the Trudeau government balances the budget, if they keep going this way. Geez. All right, Franco, I've heard you talk about the inflation tax many times. Of course, deficit spending is a big part of the issue, but it's really a portion or maybe half of the issue. And I know the other portion, which you also love to talk about, is the role that the Bank of Canada has played in terms of, revving up the printing press. So can you explain how the printing press has contributed to this as well?
Yeah, sorry, Jay. I'm here in Ottawa, so it's hard to hear you because all I can hear in the background is the brrr of the printing press right down the street on Wellington. Look, I mean, at the end of the day, it's actually more simple than you would think. The more dollars that the central bank, the Bank of Canada prints, the less that your dollars in your checkings account or your savings account will buy. Now, the Bank of Canada prints new money by buying financial assets like government bonds. So whenever the central bank buys one of these government bonds, it does so by creating money right out of thin air. And the Bank of Canada was doing this on overdrive during the pandemic. Let me just give you some numbers. So between March 2020 and March 2022, the Bank of Canada printed about $370 billion. Okay. Now, that's a 300% growth in the Bank of Canada's assets. It's significantly more than what we saw happen during the recession of the 70s, the 80s, the 90s, and also the 08-09 financial crisis. Now, remember, folks, the Bank of Canada printed these hundreds of billions of dollars out of thin air, and it dropped it into an economy that was largely shut down because of the government's lockdown measures during the pandemic. So this essentially creates the perfect storm for inflation, which is too many dollars chasing too few goods.
Yeah, exactly. And then, of course, we talked about the printing press, we talked about the deficits, but we also have to talk about higher taxes. And the Bank of Canada which of course is trying to get inflation under control right now. Obviously, they've contributed to inflation, but now they're raising interest rates to try to deal with it. But they've actually said that taxes are an issue here. And they've said that the carbon tax in particular is part of the problem.
Of course it is. I mean, duh. Right? I mean, the only people who are debating whether or not carbon taxes are part of the problem are just like some academics or something who are getting paid by the government. I mean, look, the entire objective of the carbon tax is to increase prices. That's the entire objective. I mean, this isn't even the Canadian Taxpayers Federation having to point it out. The government's own numbers show that the carbon tax increases the price of gas by 14 cents a liter, the price of diesel by 17 cents a liter, and the price of natural gas by 12 cents per cubic meter, right? But like the carbon tax doesn't just make it more expensive for you to go to work with your car or to keep your home warm during the winter months. The carbon tax cascades throughout the whole economy. Now, what I mean by that is because the carbon tax makes it more expensive to fuel up that big rig truck that is bringing your food to the store, it also increases the price you pay when you go to the grocery store. Or because the carbon tax makes it more expensive for farmers to dry the grain, to produce the food, it makes it more expensive for you to buy that food when you're at the store, right? Now, worst case scenario is actually happening. Not only are we paying a carbon tax that continues to go up, but the Trudeau government is bringing in a second carbon tax taking effect July 1, 2023. Now, when that second carbon tax, which is buried in fuel regulations, is fully implemented by 2030, it will have increased the price of gas by up to 17 cents a liter. So we already know that high gas taxes are driving up the price today. But by 2030, folks, Trudeau's two carbon taxes will increase the price of gasoline by about 55 cents a liter.
Oh, we think it's bad now going to the gas station and calculating what the carbon tax is and all that, but this is nothing compared to what we're going to get by 2030 if we go down the same track.
We're going to need a bigger calculator, Jay.
We're going to need a much bigger calculator. And speaking of calculators and numbers, obviously, interest rates going up, that impacts us on our mortgages, that impacts our line of credit. It can impact credit cards. But of course, it impacts the government too. The government borrows a heck of a lot of money. We have a heck of a lot of debt in this country, over $1 trillion. So what kind of impact is this interest rate hike or hikes, all of the hikes, going to have on the federal government's books?
Yeah, well, I mean, essentially it just means more money wasted on interest charges. Right? I mean, it's pretty easy to understand. You rack up more debt and or you have higher interest rates. Taxpayers pay more for debt interest charges. Now, Jack Mintz is an economist at the University of Calgary. And here's what he said, quote, just a 1 point increase in interest rates would then increase the annual deficit by close to $5 billion. Now, we're already paying about $3.6 billion every month for federal debt interest charges. That's about 90% of the entire Canada Health transfer to the provinces. Okay, by 2027, the interest charges on the government credit card are going to cost taxpayers about $50 billion, which is more than double the pre-pandemic level.
Yeah, that's just nuts. And actually, I was just talking with a supporter about what's going on in Ontario, too. This obviously affects the federal government, but it affects the provinces. Ontario is deep, deep in debt, the most indebted subnational government in the world. And we're actually paying about $1.2 billion a month on debt interest. And I love to talk about the fact that you could get 14 brand new state-of-the-art hospitals here in Ontario if we didn't have to spend all of that money. So not only are the feds wasting tens of billions, but we're seeing it all across the country in all of our provinces. Ontario certainly leading the pack there. So Franco, obviously there's debt everywhere. The feds, provinces across the country. How do we deal with this? How do we get out of this mess?
Okay, well, I think the big mess facing Canadian families right now is the high cost of living, whether you're talking about higher prices at the store, higher prices when you're at the pumps, or even just worried about your mortgage payments going through the roof. Well, when you're in a hole, stop digging, right? So interest rates are going up because of high inflation. And there's a lot of things the government has done and is doing to make inflation worse. So stop doing that. Stop the money printing, stop the never ending deficit, stop the tax hikes, right? So essentially the two things that the government should do right away is balance the budget and scrap the carbon taxes. Now, the carbon tax, by the way, is something that the government could do immediately today to immediately provide relief for families. Okay, so right now, the government could save a family about $10 every time they fuel up their minivan just by scrapping the carbon tax. Just by scrapping the carbon tax right there. And, you know, we've actually seen other countries around the world do this to provide relief, right? We saw Australia cut its gas tax in half. We saw South Korea cut its gas tax by 30%. We saw the United Kingdom announce billions of dollars in fuel tax relief. You had Germany, you had the Netherlands also provide some significant fuel tax relief. And you saw many provinces do the same thing. Ontario, Premier Doug Ford, he cut gas taxes. Newfoundland and Labrador cut gas taxes. And in Alberta, you have the Danielle Smith government completely suspending provincial fuel taxes. So that's how the government, the federal government in Ottawa, could immediately provide relief today.
Yeah, I think the really worrying takeaway here, of course, is that families could be paying thousands more to renew their mortgage if things don't change. We have seen, definitely, here in Ontario, in Newfoundland and Labrador, in Alberta, we have seen examples of lower gas tax. It can be done. It is being done right now here in Canada. So this is definitely something that the federal government could look at and pursue quite easily. You know, as I was saying too, with the interest rates, it's just tough. It's tough to make ends meet. You know, a good friend of mine has a variable mortgage. You know, some people have fixed mortgages. I happen to have that, and we're lucky we don't have to renew for a few years. A friend of mine has a variable mortgage, has a place in Hamilton. His mortgage has gone up, the mortgage payment, by over $750 a month. So
wow,
this is impacting a lot of people right now. Because some people, whoever chose a variable mortgage, they're getting screwed right now. So this is a huge problem going forward, but for many, it's a huge problem right away. Obviously, as we said, a good takeaway for sure. Interest rates are going up because of inflation, and inflation is being helped along in large part by what the government is doing. So clear takeaways here. Families are going to be hit hard now and down the road, especially when it comes to mortgages. And the government is helping to cause inflation, which is helping to cause the higher interest rates. And there are ways, folks, there are lots of ways that the government could be acting to help actually meet this challenge. So if you want to learn more about all of this, the inflation, the interest rates, how everything's tied together, Franco has a really good op-ed in the Toronto Sun you can check out. It's in the show notes. And you can also find it on our website, taxpayer.com. Franco, I just want to thank you for joining us. And you know, it's a lot of bad news, but it's sobering news that everybody has to hear. So thanks for joining us and outlining not only the bad news, but also what we can do to change it and what we need to demand from our governments to try to change course. Thank you very much.